is there any reason to buy anything other than short-end paper at the moment on the govie market?
Well, I think the question is really, what do you think, what's going to happen with interest rates and growth going forward? I mean, I think that probably over the next month, the long end of the government markets will still be pretty stable. But when you look out, say, 6, 9, 12 months, we're probably going to see slower growth. And as a result, you actually could continue to see start to see long-dated bonds begin to look attractive. So it's probably too early to get optimistic on the government markets right now. But at some point this summer, it will become a very interesting purchase.
Point this summer, though, Guy, because that's the million-dollar question, isn't it? The timing of the Fed and other central banks move away from rate hiking, perhaps to holding the look or potentially even cutting.
Yeah, I mean, I think the U.S. continues to be really the lead in terms of monetary policy. As you mentioned earlier on in your show, when you look into the underlying figures in the German inflation data, and that would be true in any European country, things take an awfully long time to work through in Europe. And we still are in a mood in Europe of higher interest rates. Isabel Schnabel made that very clear in her recent comments. Probably the market still isn't anticipating high enough rates, so we're probably still looking for rates with a 4% handle ultimately in Europe. But in that kind of environment, even if you have continued hikes in short-term European interest rates, as the growth outlook slows, you can actually see the long end of the market outperform. So you could see the curves get even more inverted.
Guy, I take on board fully the accusation that I'm a broken record, but it's a broken record that has a point about high yield, otherwise known as junk. We're nowhere near the kind of levels that one would expect to see in terms of accompanying a stunning rate hiking cycle and then the concern about delinquencies thereafter. Is there a stunning amount of complacency in the junk end of the market?
Well, I think in the U.S. market, yes. I think that's definitely true. I think if you look, one good leading indicator for defaults is the tightening in bank lending conditions. If you look at the bank lending conditions in the U.S., they're as tight now as they were in the COVID period. In the COVID period, we had 8% defaults. So we can see a repeat of that kind of environment. And in that context, U.S. high yield spreads, no, do not reflect that kind of risk. In Europe, it's a little bit more mitigated by the fact that historically we have lower levels of defaults. But I think where the U.S. high yield market leads, Europe will follow. So I would generally agree with you.
Guy, can I ask you about the fallen angels specifically? Because at some various points in time, the market rakes back over them and says, look, this is a great environment for upgrades of some of those fallen angels that are doing all the right things. The market environment is great for them to reclaim their status of a high debt rating. This time, as you look at the cycle and the amount of complexity out there, how do you view the chances of fallen angels improving their lot?
I think the timing is bad for this kind of improvement. I mean, this is very much a macro issue. And as we just talked about, if high yield spreads don't reflect enough bad news and they're going to go wider, well, I think the rating agencies are also not going to be upgrading companies. So I would be more concerned about ratings downgrades from investment grade to high yield than I would be picking through high yield looking for upgrade opportunities.